Okay, brilliant. Welcome everyone. Good morning to the welcome to this Sunday special property chat with the usual team: Adam, Ross, Helen, Jay. Welcome
Morning.
back.
Morning, everyone.
Morning.
Brilliant. So, what's happening this week in the property and in the world in general? So the Sunday supplement's gone out. What's been covered in the Sunday
Yeah,
supplement?
I deliberately went for late release this week, so you guys couldn't gen up on it. So you got no idea what it says. It's pretty mean, pretty mean. But I've had to have a tuck into the government this week because you couldn't let this week of news pass without sliding a couple of knives in the side of the biggest backstabber in the business. Anyway, Big Boris, could you? Let's face it, So.
Okay. All right, so we've got the government thing going on,
And then we've got some little inflation chat, a little bit of how much the UK has done better than the US, in my opinion, in the last couple of years. Bit of patriotic, no, but there's more to it. There's more to it than patriotism.
Nice.
And yeah, a little bit of the what we're going to expect in the new year, I think, as well.
Okay.
Starting to get to that time of year, isn't it? Prediction time and all the rest of it.
Yeah.
Oh, yeah.
I think a phrase "little inflation" is a bit of an oxymoron right now, but
I think he meant there's only 14 paragraphs on it.
Who are you calling a moron, Pierre?
I've said this before. If only someone had been producing a concise and easy to digest Sunday periodical that had mentioned inflation for the last 9 or 10 months, we'd all know where we're at. But luckily, someone has been. Yeah. Sorry.
nice.
I mean,
Nice.
if we're touching on predictions, I think next year there's going to be an absolute explosion of stock entering the market in Q1, Q2.
I hope you're right, Jay Howard. I hope you're right. I love that. I love that chat.
I've got to be the most popular person for predictions for the beginning of next year, right? Like everyone wants to hear that. But yeah, I mean, the government. I mean, I know I haven't had a chance to read your supplement, which is always brilliant. But the government's been kicking the can down the road a little bit with eviction bans, repossession bans. Just kind of dragging out the distress element in society. It has to come to a head. There's only so much they can protect their votes and their voting power, right? But I think next year you're going to see a lot more of the repossessions, and I think maybe we're going to see more conscientious style repossessions. So more of the kind of voluntary stuff where the banks take control over the sale, but there is there needs to be a little bit more of that. And actually, one of the corporates that I've been speaking to during lockdown, a lot of the corporates that dealt with the asset management stuff on behalf of banks and people like that, they basically closed most of their teams down and sent them off to different areas in the business or different countries and did all that kind of stuff. But one of them in particular basically said, we're not going anywhere, but what we're going to do instead is we are going to approach the banks and say, look, anyone who is in default, the fees are starting to rack up and stuff like that. Why don't you let us approach them and see if we can sell for them pre receivership or pre-administration or pre whatever it is. And they were doing really very well. And they're a massive corporate estate agent as well. So their numbers on sales went up, and you could only divinate that their numbers of sales went up because of this conscientious repossession model that they were looking to apply. I don't know how many other of the asset managers, the repossession agents, have taken that kind of approach, but it will be interesting to see in the new year either way.
Well, Jay, that's really interesting because are you suggesting that they've gone about approaching the banks with look, you've got a serious reputational risk event coming up whenever the can stops being kicked so far down the road, and therefore maybe we can help to manage the PR side of it, which I've said for a while is a big concern for a lot of these lenders, and I can imagine that appealing to the internal executives at the banks. Is that the sort of approach that they're using?
That was and also the problem with that most of the banks face, and we saw this in 2008, is they didn't want the debt to crystallize. Exactly. They don't actually want massive swathes of repossessions. And obviously reputationally, but also credit risk and all that kind of stuff, right?
Yeah.
But what I think they were doing is they're approaching the bank saying, look, they're in breach of the mortgage. They're technically in forfeiture. They're going through this entire process. Why don't you put a stop on the admin fees and late payment fees? Let us get the assets sold, get your capital sent back to you, the remainder sent to them. They go into rented, or they buy a cheaper house, or they wait for things to change, whatever it is. Your debt doesn't crystallize. You don't get that bad image, and there's a problem solved. But I think I was talking about 15 or 20 of these asset manager types, and there really are a ton of them. This was the only one that was doing that. And the interesting thing about that is this is the only one where the guy who was leading that team was a former hedge fund manager. All the others, yeah.
Purely from a bottom line perspective, it's going to make sense. Like on the numbers front, it's like they're probably, if they can get in there and they know how to sell and they've got the right people kind of lined up, they can do better than I've heard some horrific stories lately of administrators and receivership companies like flogging assets or actually drawing out and prolonging that process and stuff. That it was actually, I recorded a podcast with Will Mallard. He's got some great stories about this, but where these assets could have gone for significant sum, and because of all the admin, all the red tape, all the loops, because the people that seemingly in charge of this stuff, getting rid of this stuff, well, in those examples, didn't seem to really understand the market or what they were doing, and money was wiped off these things. Well, why not get out here rather than getting out here? Like, that's music to anybody's ears, particularly our hedge fund guys, right?
Well, what might be interesting on the back of that is the idea of, how the sort of an audit isn't really the right word for them, but the vast panels and stuff of the world who integrate themselves into the surveying process and have done really sort of since 2008, provide another layer of defence, but also a level of transparency that exists within the surveying sector. I wonder if there's perhaps an opportunity there for someone to do that within the repossession / receivership / LPA sector as well, to say, you know what, there is an element of governance in this process. So if we do need to move really, really quickly, we actually can do, and we can make it happen. Because there's always going to be that conflict of interest between, oh yeah, we'll look after this asset for you and 2 years worth of asset management fees versus actually getting rid of it. And if it puts another 300 grand in our pocket versus 3 million quid in somebody else's pocket, well, that's business, and that's not really cricket, is it? So there's maybe somewhere in the middle where there might be some room for someone to, potentially offer that as a service if going along the lines of your entrepreneurial contact that you've been talking about, Jay. That's very interesting.
Well, I mean,
is there any idea of volume?
Well, no. So a lot of the guys that I was talking to, I would. You have to draw comparisons to like the last big time something like this happened. Mm-hmm. I said, so are we looking at another 2008, 2009? And they said, we're not expecting that kind of level. But the stuff that they've been able to deal with is, their backlog is unbelievable. And then there are two other areas within that marketplace that requires court judgment to get to, like, I think they call it like a Section 60, whatever something it is, where they actually have to go to court and get the court order to have it sold, right? So and obviously the courts are massively behind. Mm-hmm. The courts, the local authorities are behind, planners are behind, everything's behind. So it's all of these choke points along the process that are so they don't think it's going to be a massive explosion of stock in one go. They think it's going to be very much every 2 to 3 months is going to be another burst of distressed assets reaching the market, or moreover distressed sellers rather than the actual assets themselves being distressed. But I went to a couple of R3 events. Has anyone heard of R3? It's the receivership conference. They do like a big one, normally in Portugal or in Ireland. I went to the one in Ireland. You cannot miss fresh Guinness pretty much out of the cow's tit. It was unbelievable. And then I didn't manage to get to the Portugal one.
That's not how they make Guinness, by the way.
Well, I've been lied to.
Don't make Guinness that way. That's just.
I've been lied to because they told me the frothy top was because it was fresh. You know, and they have all these kind of these talks, and I just went there for certain sections, but I sat in all the talks because I'm a bit of a geek. I imagine Helen and Adam would have done exactly the same thing.
Love that.
On every single talk. But it was unbelievable. There was this one talk from a chap saying, look, a lot of the receivership stuff with sales of property is being contested in court. This was pre-COVID. And these are some of the ways that you as a receiver or an administrator can protect yourself from this stuff happening again. And they were talking about record keeping. They were talking about getting 3 or 4 valuations or repeated valuations if the property's on the market for longer than 3 months. They were talking about sales at auction, which I know interests a fair bunch of us on the call. They were talking about all of these things, but the amount of times this is argued. So I was there and they were talking about this case. I can't recall the name, but it was a development. It was a sale of a development. And they were saying that the receivers had sold it for about £600,000 below like the value of it. And the receivers were making this big argument, this really big argument. They had a couple of specialists as part of like this court action. And one of the specialists said, look, it could be worth £600,000 more than what it sold for. It could be what it sold for. So the problem that you have is the developer went bankrupt midway through the development. Now, for anyone who understands these things, understands that once a developer is finished, hasn't finished the job, and you need more tradespeople to come in, actually, your warranties can get trouble. Your building certificate, all of that kind of stuff. Sometimes you even have to go in there, strip stuff back that's already been done, to then relayer stuff that hasn't been finished yet. So there's massive kind of additional costs that the developer hadn't taken into consideration. I imagine because the developer had never gone bust before, so they didn't realize that a new developer or a new contractor coming in would have to, get a lot of things signed off. There'd be, all of these things. A developer on this call would have to go more into the detail if we wanted to, but and it was basically the judge found in favor of the receiver because there wasn't an easy enough way to calculate the additional kind of cost of going back and undoing or redoing works that had already been done, and then calculating the time scale in that and all the other things that go with it. So, it's a very difficult. It's kind of like trying to prove fraud, isn't it?
Yeah. Who was on the other side from the receiver then in that?
That was the developer.
So the developer who had gone bankrupt was suggesting the receiver hadn't secured a strong enough price for it.
Yeah.
Wow. That's quite ballsy. That suggests they kind of have more money than they can understand the system better than most people.
Well, from what I understand with most developers is that although they put some skin in the game, if a development goes wrong, it's normally within an SPV or something like that. So for the larger part, and there are probably investors on this call that could explain it far better than I would ever be able to. For the large part, their wealth is protected, independent of a single development or a group of companies going down. But that's my understanding.
I think there's quite a really simple level though in that situation. If someone offers me a half-finished development, I've never bought one and particularly got stung by it. I mean, I suppose I've done I bought houses where someone's been halfway through a refurb or 80% through and given up, but not. I mean an out the ground build or something like that. And maybe this is because we've gone 14 minutes. We haven't said the R word yet, but maybe this is just good risk management.
You weren't listening. It's been said. It's been said already.
I haven't said it yet. But it's my contractual right to say it first, so I'll be watching the replay. But it is something that naturally kicks in, and you think, well, but what if this? What if this? Well, first fix is done. Oh, is it? Because I've spoken to people who said, well, actually, there was no plumbing in under the floor. They put en suites in an HMO. I've seen it, firsthand. But there was nothing under the floor to do anything. So they've done enough to kind of make out like they've done this stage of the building works and pulled the wool over someone's eyes. And obviously that goes on at a massive scale especially when people think something might be going down and payments are getting slower and all the rest of it. So there's so many reasons not to do a development like that, and the only one that there can be to take it on is that the price is too good to refuse, realistically, in my miserable way of looking at the world anyway.
So I've done a few of them where we bought off developers who've gone bust midway through. I'm not suggesting anything nefarious, but the warranty providers basically walk away from them. They have no interest at all. Finding another warranty provider is an absolute nightmare, and actually getting warranties for buildings in general just now is quite hard. So anything that they perceive extreme risk with, they just won't touch. And I found that my church had obviously had the fire, even getting my current warranty provider to extend the warranty, and I was still the owner and could prove everything that we'd done, was just absolutely horrific. It went from, I think it was about 35,000, which was the cost of the warranty to start with, and their opening gambit when they said yes, eventually they would do, was £280,000. So it wasn't even
talk about opportunistic.
It was just mental.
I mean, there's increased risk, but still.
Yeah, but on developments just now, so there's quite a lot of them kicking about for a variety of reasons. One is contractors can't finish and are going bust. Secondly, a lot of the developments that are going around just now, the contractors are struggling to finish. And did I go off? Did everybody go off?
No, we can hear you, unfortunately.
Yeah.
We can hear you, but it's your video froze. But you can, I think, carry on talking.
All right, so carry on talking. So I think developers are struggling to do things. Contractors are going bust. Cost of materials has gone up. So now they're thinking to get things finished, they're actually going to be making a loss. So they're pulling the plug much earlier than they were before. So just now I've been looking, I was back in the UK for about 3 weeks there and looked at quite a lot of part finished developments. And in fairness, none of them stack up. Now, numerically, they stack up from the start of the development. And
at the beginning.
Yeah, so from the beginning, but everything has changed now. Yeah. The banks, we've been going through a process for development finance with some of the big lenders. And whilst we've got to the end of it and we've managed to get 3 or 4 options that are reasonable, and 2 are actually really good, if any of the guys are listening. But to get to that point is only because we've got quite a lot of experience, both myself and the contractor I'm using. We're doing it as a joint venture as opposed to me being the developer and him being the contractor. But it's actually really hard to get development finance just now. So I think
that's the only way to do it at the moment, isn't it, realistically, to manage that? I mean, your traditional sensitivity analysis where you're looking at, what happens if things change by 5 and 10%. 10% is not enough. It's nowhere near enough.
But if you look at how the market's been with prices increasing, people have been bidding more for the site without actually looking at the costs.
Yeah.
In effect, sites just now, I think, are going down in price, or should be going down in price notionally. If you had a computer and a spreadsheet, you would think that. But most
if only someone had said that in an easy to digest Sunday morning periodical last week, then we could have discussed it.
that would have been good. Perhaps we should just make everybody in the call read it beforehand, then it would be much easier. It would be a wee bit more current and not a week out of date.
I'll circulate the Cliff Notes next time, boss. Sorry.
Thank you. And could you just read through it? So it's hard. It's really hard. Nobody wants these second-hand developments, as in banks, lenders. People will buy them if they're sitting in cash, but there's not a lot of money to be made out of them.
And also, mate, if you could point out the landowners who are going to accept the argument that the price for the land has gone down, even before a development started, they don't want to hear it. But really based, when we talk a lot about auction and how it's sort of the early warning system and stuff like that, you can see that. But the biggest mistake that's been made in my mind in the last 12 months, and it's been a bun fight. There hasn't been a lot of stock, etc., etc. But I've been saying for months, these houses that need significant refurbs, the value of them is going down. It's not going up. Just because the GDV is going up, the cost of the works is especially when you're looking at the sort of stock that I like to buy that Rob tells me off for, nice cheap location, lots of work needed. But the works go from 25 to 37k, let's say, and therefore what happened? Okay, but the GD it's up 12%. Yeah, mate, but 12% isn't enough. It's gone up 9 grand, and the works have gone up 12 grand. So it's worth 3 grand less. And then with the contingency is larger, so actually it's worth 5 grand less. The auction room doesn't agree with me, and I say to them, well, You guys get on with it, and good luck. Let me know how you get on. And that's why there's all these half-finished projects.
Yeah.
Exactly. We had a woman, I think it was a lady, came on one of the elevator series and done all the numbers, super great spreadsheet, and she'd put something like 20% contingency in, and everybody's like, whoa, that's a lot. And I'm like, in this market, you categorically need it. I remember reading something that Rod wrote about kind of like the cost of timber. The increases, what were we up 50-60% on those? So if you've started development, based your numbers, 12, 18 months ago, and, and the supplies weren't in then, or weren't ordered, or the price wasn't fixed then, what are you looking at? It's, shocking.
So for a lot of developers are trying to renegotiate with contractors just now, because developers are struggling. The contractors, they're struggling more because they're in fixed price contracts, but their costs have gone up, and they probably pitched for the job on smaller margins with the view that they're going to be able to take more money out for other works that are required. But the reality of it all just now is it's the holy grail of difficulty for being a developer midway to the end way of a project. We've got 2 bigger projects going just now. One of the ones I have, I think my contractor has struggled for the last 3 or 4 months, and not necessarily my project because it's cost plus, but on other projects he's been on, I think because he's on fixed price contracts, and they're big things. So he was hoping to make money out the margin, or the margin was going to come from the volume, the size of the project. But the reality is, if you're doing 100 houses somewhere, it's 100 times whatever the cost increase is. And if you're a smaller contractor or a subcontractor, you're just getting bashed at the moment. It's really, really tough.
Ross, I've said to you for years, haven't I, that I've always preferred the high margin, lower volume than the low margin, than the supermarket style model. I mean, the supermarket's a bad example because they have a number of other advantages in what they do. They're selling a staple good apart from anything else. But if you build a business based on doing 200 deals a month, and your burn rate for that is a 6-figure sum every month for marketing and staffing, then ultimately when there isn't much margin, and I've seen it firsthand, and I'm sure Jay and Piotr will have seen it as well, these guys are just paying too much for stuff. An auctioneer who sometimes listens into some of these calls, I spoke to him a couple of months back because he'd listed something and it didn't sell. And I said, look, I was, officially sniffing around, let's say. And he said, well, a London trader's bought this out in the provinces and they've paid 120 for it. And I was like, but how can they pay 120 and expect to make a profit? It's, I give them 110 and that would be reasonable. Instead, they held on to it for another 4 months and shipped it for 116 and took a bath. And I think there's loads of examples of that at the moment, with people desperately trying to keep volume up, and the volume hasn't been there. And of course, the only way to keep volume up is to take bad risk in these situations. And it's just poor governance and lack of flexibility and lack of vision. It hasn't taken a genius to forecast, inflation and what's happened to commodities. That we had the warnings in Q1. If you didn't act on that, then you're not running your business properly. I'm sorry, it's simple as that.
Well, on the trader point, Adam, I know a trader who, several traders, but one of them I know, he sticks to a very, very tight regional area. He knows his P's and his Q's. He doesn't really buy outside of that. He's attempted once or twice to dip into the London market, but his numbers are always far too well. I mean, he does maybe 20, maybe 25 deals a month. And he's looking for an average return of £5,000 a deal, like net. And you think, oh well, that's 20 deals. That's a lot of headache. That's a lot of arseache. But actually, once you compound that effect of £5,000 a deal on a monthly basis, that's not a terrible return. Considering he's a bit of a one-man band, he understands the market in terms of the auction market and the buying and selling market. He's a skilled chap. But then there's a couple of other people that also kind of regional or tend to stick to their kind of areas. And I think there's a bit of a change at the moment. I was talking to a couple of the BMV providers, the We Buy Any Homes, the property buying company types, not those two specifically, but those kind of companies. And they buy regionally. And one chap who is a little bit of a one-man band has been going up to kind of like the northeast on a once or twice a week to look at stock. And he's like, well, I'm buying it on a yield basis. Okay, well, it's not a bad metric when you see the yields in those kind of areas. But I said, what happens when you wipe those yields down? And you don't understand the area. You don't understand the there isn't a pound per square foot metric in certain parts of County Durham or Hordern or Peterlee and places like that. There isn't. Those areas operate on a completely different set of metrics. You can go in there and you can do a beautiful refurb, but in 3 months they've taken the light fittings and the copper piping.
I think in a few minutes we'll have to start talking about blockchain, and I think this is probably quite a good way to transition towards blockchain and crypto and all the rest of it, because in reality there's two real ways to look at this sort of stuff. You either do the castles in the sky, as I call it, which is, well, tomorrow someone's going to pay more than I've paid today. Okay, jolly good. And that works until it doesn't. And when it doesn't, it is a hell of a bath to take, right? Or you can get involved in stuff that and what you were alluding to there, regionally, that you understand. Where does your advantage come from? We bought a building this week in an auction, and the advantage is I know how to get through to the end value and where the financing is going to come from and what it's going to cost. Now, even if I'm not saying I'm the only person who can do that, but even if you can replicate 2 out of 3 parts of that triangle, you probably can't replicate the third without having the same sort of setup as I do, the same sort of connections as I do, the same sort of track record as I do. And so we've probably been able to buy something. I think we'll be in at about 55 pence in the pound by the time we get the revaluation, and there'll be a very decent rent roll involved. And it's an unreplicatable asset that's got barriers to entry. I mean, there's a lot of reasons to like it, but we bought it at the guide price and live at the auction, in the impossible market, which is now a lot more possible, to be fair. We've been saying for the last month or so that there's stuff out there. And I know, Piotr, Jay, we've been discussing bits that are, there's some stuff we've discussed has gone at, right sort of money, I think, really, to the right. I wouldn't have been a long way off. I don't think you guys would have been a long way off. So you can be pretty sure they've sold at the right sort of price. So it's worth people, if they've been thinking auctions got too difficult, taking another look at what's going on in the now, because it is very fluid.
There's a lot of potential deals to be done at the right money, like you say. And I think also we see a lot of properties being sold at reserves below the guide prices, even because people are just motivated to shift things, and the guide price doesn't now necessarily mean that things have to go for 10%, 20% above. It just means that it's more or less what the seller's expectations are, and things might happen. So it's really worthwhile registering to bid. We were bidding 2 weeks ago on something, which it was guided at 165, I think,
165.
and the actual reserve was met at 150, and I mean, it still went for 272, which was stupid.
Not the best example, maybe, Piotr,
No.
unless it was worth 400.
There was some good barriers to entry there, but I don't think people saw them.
Yeah, and to be honest, I don't think people like the 277 or 272 person overpaid. It's like there's a couple of risks in that deal, but I think they can be managed. So we were just below that because we didn't bank on things going well. But if things go well, I think that's still a really decent price. But what I'm saying is it's worthwhile just registering to bid and then going for it. We had a couple of people in the Auction Buyers Club who did deals post auction and or just after auction on the things that they registered to bid. So,
well, mate, for the first time in about 22 months, we got an email from an auctioneer saying, I don't know if you saw these last night, but they didn't sell. It might be worth you guys taking a look at them. And it's like, oh, having to work a little bit harder than you have done for the last 22 months.
Wow.
Good sign.
Yeah.
We were looking at a property, a rather attractive building in auction, a little bit higgledy-piggledy, not massive ways to add value unless you were going to, re-rent and get market value on rents. And there were a couple of empty units in there, etc. There was about £1 million worth of kit, and we were talking to someone and said, look, we can structure an underwrite for you on this. What figure would you be at? And they're like, well, they were ultra conservative. They said, about £800,000. I didn't ask them what metric they came up with. I just said, okay, well, let's see what happens. Maybe it won't sell, but I'm pretty certain it's going to sell. It then sells for like 1.682 or something ridiculous like that. And I said to them, I said, look, if you're a little bit ballsier at the million mark, which stacked on 3 or 4 sensible metrics, you could be looking at about £300,000 cash prize without having to actually buy the asset. And it's showing that, once you start hearing more and more about underwrites being possible, it feeds into what you've just said there. They're now sending you the post-auction stuff saying, well, actually, it wasn't as gravy as we thought it was. Maybe you can pick it up. So, no, there are some very, very strong indicators out there that there is not necessarily weakness in the market, but there's greater opportunity in the market. And I think that's what's been lacking at least for the last 9 to 12 months.
So the only caveat I would say to that is that if the change in the market is the precursor to a collapse, people might have to be careful about what types of things they're buying. So if, Jay, you're saying you think there's going to be a ton of stock onto the market, direct quote from earlier, into maybe quarter 2 of next year, people are going to have to be careful to make sure they buy using the kind of strategies you've talked about before in your Auction Buyers Club, which is that they're having to buy things where there's quite a lot of value can be created out of them. So the simpler ones, the ones that Adam and I have liked in the past, which are the kind of traditional ex-local authority houses that are sold a wee bit undervalued, there's a bit of a risk buying these just now if there's a collapse in prices. I don't know if there's going to be a collapse in prices, but it's just quite a lot of the people that I know that watch this are probably not at the stage necessarily, especially out with London, of buying bigger projects. You just have to be careful, because I think just now some things are selling really well still, some things are sitting, single units. There's a natural, people seem to have been buying things in areas that you wouldn't necessarily buy deals, but that's only because there's no deals available in the kind of core central areas. You just have to be a wee bit careful and take advice as to, is what you're buying going to hold up value-wise?
I think that's really good, and I think I'd go even a little bit further than that and say it doesn't even need a collapse. It needs something that looks like it might be a collapse to really affect a few people's confidence, and especially funders who we've already discussed are potentially getting a bit itchy over some of this stuff and looking at the fact they might be underwater on a few loans and all the rest of it because of things being not finished and being halfway through and having drawn down half the funding but not added half of what they need to the GDV. For the reasons that we've discussed. So I think it only needs to look like that could happen. I think it comes down to not overexposing yourself, robust balance sheets, etc., and what to do. You always find out, don't you? It's like the whole of the pandemic. You see the best of people, you see the worst of people. You only find out how good someone is when something goes on fire at 3 o'clock in the morning. Sorry to drive the hammer home, but you do get to see. It is the measure of the developer, and those conversations we had, Ross, around, you're the best person to take it from there to where it was going to be in the first place, and convincing the lender of that was maybe not as easy as you would have liked it to be at some points,
Yeah, absolutely. But that's the whole thing about property, though. There are always challenges. There are always things going on. I just think just now, there's so much social media around, and yes, it would be lovely to think from a property perspective that there are going to be more deals. It's just that it's going to be measuring when to jump in, what deals actually are going to work. I've been watching, because I've not spent as much time in the UK recently, I've been watching more on social media. I've been watching trainers, educators of all different types, telling people what to do, how to do it. Lots of people saying there's a collapse coming, so it's going to be a great time. Get yourself a cash pot, borrow your auntie's pension, do this, do that. It's all starting to feel a wee bit like people trying to cash in on the demise of a marketplace if it happens. The reality is 2008 was a horrific period of time to be a property developer, to be a trader, to be an investor. There's a chap, Bobby Gilmore, who I'm friendly with in Glasgow, and he did really well through it. But he was really clever in the way he generated cash out of working 20-hour days and doing all these things, and bought repossessions and bought empty properties and small things. He didn't overextend himself. And he ended up building up quite a chunky portfolio just out of being clever about how he did it. And that was a really good way of doing it. Whereas I, for 2 years, from post-2008 till probably 2010, was going around trying to borrow money, which I found really hard because nobody wanted to lend it, and buy property, which was really hard because nobody wanted to sell it at the right price. So I was like Mr. Ben every day, going out trying to work out what my job was, until after 2 years, I think I eventually thought, well, I can't keep doing this for 2 years, going and having my lunch in a park bench, sitting on my own, kidding on I was a property developer. So I get a wee bit of the feeling just now, people are being told, get your cash built up, get your cash reserves built up. We're seeing the market starting to slow a wee bit, but nobody really knows where it's going to go. And nobody really knows if it's just a natural consequence of the end of COVID, or whether it could be a more general slowdown in the market and prices start to come back to where they could.
Well, and you know, there's all the money in the world out there at the moment, but that doesn't mean that the money won't hold off if it starts to feel like there might be a bit of a slide, because the money wants to buy at 60 pence in the pound or whatever, you know. So it's there's been a cushion of money going into less sophisticated hands, thanks to your bounce back loans and all the rest of it, right? Has that worked its way completely through the system at this point? Potentially, arguably it has. And we're now in payback period of all of that, and therefore there's a cash drag at the, you know, more S end of the SME market, and then you're dealing with the much more sophisticated hedge fund style thinkers, asset managers, etc., etc. So caution definitely, but the right stuff. I think it's like always, the right stuff with the right reward, isn't it? Which is the same in any, but because the volatility is higher, there has to be a bigger understanding of how to control. You know, I've said before, we've done lots and lots of, right, it's already tenanted. It's not even the tenant's not paying, the landlord just wants out. We've done loads of that this year. Because from a risk perspective, the risks have been very, very low. You know, and it's been, you know, it's been a bit of bread and butter stuff to do. It hasn't set the world on fire, but it's been good bread and butter stuff that's kept us going while we've been watching stuff and going, wow, that sold for 30 grand too much. That sold for 100 grand too much. That's, you know, all the rest of that. So that's where we've been at.
It feels very much like we I don't think we've been in a fundamental market for a very, very long time. This is kind of action and reaction. It's cause and effect. The problem is we haven't been in a situation like this, you know, in a mature financial and monetary market for a good couple of 100 years, right? You know, 2008 was exceedingly very different from where we find ourselves today, more so in the way that the government's handled it. You know, in 2008, you know, the helicopter funds went to the big nationals, the institutions. This time it didn't. It went to the, you know, the average man, the SMEs, all that kind of stuff. Because they thought, actually, instead of cascading the money down, why don't we pull the money in here and let that kind of work its way up? And that's been really very interesting, because I think early on in the COVID thing, not many people were expecting that. People were thinking, right, what's happened before? Will that happen again? And if it happens again, this is going to be the reaction to it. I personally think the reaction to having a massive swathe of new stock entering the market in the beginning to middle of next year is probably, and I think you're both right, it's going to make it look like there is a market crash, whereas in reality all it's doing is it's elongating the competition metric. Right at the moment, the competition metric is compacted because there's not enough stock, so the number of people vying for that stock is massive. When all of the stock opens up, that competition is going to elongate out and spread. Now, you know, a lot of people are going to be buying based on recent sell prices, which again is not a terrible metric. Even when you're working out pound per square foot, you're doing it on recent sell metrics. I think the smart money coming up is actually going to be looking at pound per square foot values 18 months ago and sell prices 18 months ago, because what you're doing is you're almost not negating the last 18 months worth of value add, but what you, or not value add, market sway. What you're doing is you're baking in, you know, movement in the market.
Yeah.
And the market's moved massively upwards in the last 12 months. No, I say we, as myself, Piotr and Helen, found ourselves at a networking event this year together. Rather nice one. Champagne was flying. It was a beautiful environment.
Of course it was.
Was it flying or was it flowing?
Wouldn't you, H?
Pardon?
Was it flying
Helen
or
wouldn't be
flowing?
there otherwise.
It was flowing, but actually, because it was flowing, a lot of it was also flying. But we were there, and one of the people that were talking was like, "Oh, I've done this deal recently. It was a nice deal, a good little kind of conversion job. But I've realised an extra 42% value out of it. Does everyone want to know why?" And it was baking its way through and like tipping and teasing and stuff like this. Like, did he put extra money into the refurb? Did this happen? Did that happen? Did this happen? Did that happen? No, basically from the point of purchase to the point of reval, the market had moved in that area 42%.
Yeah.
So obviously the answer for that person was, let me draw that profit out now and not worry about the mortgage that I'm going to have to renew in 2 or 5 years' time, whether the market's going to be in the same place, right? But it just goes to show how quickly people are finding, it's very easy to look highly successful. Not saying this person isn't successful, but it's highly easy to look successful in this market where it's an upward trajectory. It's a bull market rather than a bear market without going too much.
And did they do that? Did they decide to take an offer now, or are they sticking with the deal, or what are they doing?
To be honest, I haven't actually caught up with that person. They're nice enough, and I think they were just talking about their experience. It wasn't a sale or anything like that coming out of it, just talking about where they were at. But it would be interesting to see whether they just took the reval or whether they sold it out or whether they're keeping it for rent or whatever the story is. I imagine it would be one or the two, the reval and rent or the sale. But and then the numbers stacked, based on what was presented, and I had no reason to feel like they were mispresenting those figures, because they came out in the end and said the only reason this is the case is because the markets moved forward, right? So the person was being exceedingly very honest with the position. It wasn't like, oh, I've done something super secret, join my mastermind kind of story. It was very much a...
How much is it? How much is it? Tell me, how much is it?
997.
But you know what I mean? Like, he was very honest, and look, my numbers here made every bit of sense, and the deal stacked on these numbers. But by the time we finished and got the reval, the numbers were up here. So and then went on to explain why that happened. But I think there are a lot of people, when you say, some immature money maker, money movement out there is very much, everyone is successful in this market. But the reality is, when we see, something coming out maybe in the next 3 months where a whole load of stock hits the market and then sale prices are not going down because the market's going down. They're going down because the competition to drive the prices up is now spread drastically across the board. And it's going to be really very interesting to see where the auctions end up with this, because I get the feeling there are 5 or 6 auctioneers that are really sitting on the fence about whether they go back in room.
Jay, can we just go to, I think you said some super interesting stuff today. And could you put a bit, for the geeks like me, could you put a bit of colour around how much more stock you think it might be in percentage terms or in absolute terms? Because there isn't loads of auction stock that goes through every year, as we all know. So it doesn't take
of the market.
huge. Yeah.
So, I mean, it's been rather well documented by people who do numbers far better than I do and have access to numbers far better than I do. So I the Bible for auctions for me is the statistics that Essential Information Group put out once a month and all that kind of stuff. And David has been really very clear that depending on where you sit regionally, let alone nationally, there's an aggregate between 25 to 30% reduction in stock nationwide in auction, which is you get 2,500 to 3,000 properties sell at auction a month. And to realize that is only 2%, only 2% of the market is ridiculous. Yeah. But, the understanding is that it is going to breach pre-COVID levels. So it means that the market is likely in auctions, not just alone, because a lot of the corporates use open market stuff as well for some of the more standard bits and pieces. But it's looking like they're expecting a 40% to 45% increase in the number of stock, which means it's going to meet the market pre-COVID, but maybe provide an extra 10, 15% of stock increase over the next year.
So you're talking a 2018, 2017 market rather than a 2019 market.
Yeah.
Yeah.
And I don't think that's overly conservative. I think that's a probably fair estimation of what they're expecting. You know, I don't think they're being coy with the numbers too much, if that makes sense.
Thank you.
Great stats.
So we had a question from last week, right, Helen?
Yes, we did.
What was the question?
I can't wait for this question because I know the rest of us are going to go on mute while Adam kicks off. It's going to be
we only have 9 minutes, so we finished early today.
Yeah, so this is from oh gosh, I can't remember his name. I'll come back to his name. But a question about Brexit, actually. How much is Brexit going to affect the housing market in England?
Yeah, and we had a bit of a joke, didn't we? Because we all gave a numerical answer as a bit of a.
Yeah. And the question's from Mustafa Abbasi. So thank you, Mustafa, for sending that in.
And I mean, from my perspective, I would say, look, it's already, going back to what Jay was saying, and I think David is very wise to specify on regional areas, apart from anything else. It's already affected some parts of the country fairly significantly in terms of withdrawal. There was a big Eastern European rental sector that evaporated relatively quickly. There's the frictional side of Brexit, which is going to take 10 plus years to work out. I think that's a relatively apolitical statement. I think people on both sides would probably agree with that, unless they're a bit silly. And the market comes back in and has to bring in. They've got two choices, haven't they? They can either work within the ever-changing, complex and rubbish visa system and bring in people from anywhere in the world instead of the EU. But as an employer, it takes longer, it costs money, it's not very efficient. Yeah. Or they can put the price up they can put the salary offers up, generally speaking, which is something else we've seen a bit of. And actually, I read a really interesting piece of analysis this week that was saying you can't be lulled into everybody's wages are going up and it's all wonderful for people. It's not at all. They're going up for HGV drivers because there's a big shortage. They're going up in some of the sectors where they've done quite poorly over the last 20 or 30 years because of globalization. But actually, overall, they're not going up that much at all. If you take out the media publicized salary effects, from the HGV sectors and transport and a few of the others, the average salary rise this year has been 0.8%, which is incredible, isn't it? But it's also very much reflective of how people feel. People don't want to. Do you want to go into your boss's office right now and say, right, this is why I don't work for anybody else, but I'm the best thing since sliced bread. You need to pay me 20% more or whatever, because the likelihood is, even if they want to keep you, they're going to say, well, look, we've got this uncertainty next year. We've got all these costs that have come on the back of the pandemic. We don't know. We've got to put our prices up in January 2022, and we don't know whether the market's going to stand it because our margins are getting, inherently massively squeezed. So, okay, thanks for coming, Adam. But actually, jog on, mate. You're good, but you're not that good. So off you go. So it has already had a level of impact in terms of the strength of some of the very localized rental markets. I'm thinking of places like Boston in links. I'm thinking of places, certain parts of the East Mids where there's quite a heavy dependency, or there was quite a heavy dependency to bring in people with upholstery skills, people, all these terrible, bloody skilled immigrants who work for less money and have got more skills than the indigenous population. I mean, they're an utter disgrace, aren't they? But that has already.
Adam's joking there, by the way.
Yeah, you missed out with a greater work ethic as well, right? So
it's worth mentioning that was a joke. Yes, thank you, Ron. But I think there's further barriers to entry to money coming into the market from abroad. Extra 2% stamp duty. We haven't had time to look at that because of all the other stuff that's happened during the pandemic. We've got a significant number of people coming in from Hong Kong, which is actually probably strategically an utterly brilliant move from the government, to be honest, because they bring in their own household wealth and balance sheets. But they won't be coming in to drive trucks and stuff like that. So it won't fix some of those. It won't be fixing some of those problems. but I think it probably, we've got a stream of the over the next 10 years of the, because population demographics are quite interesting and they're moving around, and we talk a lot about baby boomers and Gen Z and all this sort of stuff. But in the next 10 years, the proportion of the population that is between 18 and 30 is going to increase quite significantly. And we know this because of kids who've already been born, and it ebbs and it flows, and events happen and things change over time, and you're getting into the second generations and the third generations and the fourth generations of many of the people we've welcomed to the country over the last sort of 70, post World War II, really. And that will have an impact because they are the renters, generally speaking. It depends where you are in the country. If you're in Ayr, the average age of the population is forecast to be very stable and get older over the next 10 years. If you're in Coventry or Birmingham, then, Birmingham already the youngest city in Europe, there's much more of this going on, and you'll see, much more upward pressure on rents, much more upward pressure on availability, even without the backdrop of what the government are doing to the market and are maybe going to do to the market, which I've alluded to in today's supplement, just in case we need another plug. So I think, we've still got supply constraints massively. We've got some of the points that, and I don't just mean in supply of new houses, I mean in supply of new rental stock. And that's not really been pulled apart as much as I would like. So that means I'm going to have to bloody write a piece on it myself, unfortunately, at some point in the near future. There's all these I mean, it hasn't massive. We need some proper population numbers, because I read in The Guardian that 3 trillion people left the UK, and I read in the Telegraph that actually they're all still streaming in, and the reality is neither of those are true. But let's see what the ONS can deliver. It is a bit of a frustration to me that the ONS is so slow on some of that sort of stuff, but let's see what happens. But I don't think that the from an impact perspective, while we still hold the best legal system in the world, the perceived best higher education system in the world, and I use the word perceived quite deliberately there, and just generally the rule of law that we do, and the National Health Service, then money still wants to come from abroad to buy. I made a mistake of commenting on an article this week that was about Battersea Power Station, and there was some reference in the article to the fact that a lot had been sold off plan abroad, and a lot of those investors had taken quite a significant bath and lost a lot of money, as certainly at certain points during the construction phase, and they were all expected to come in, put money down off plan and make a ton of money, and it's actually a complete reversal of that. Now, of course, because it was on a public, not inside my normal, safe, lovely bubble of people like you guys, I got, apart from Mark Homer, who commented in a positive way, I got absolutely pilloried by the people saying, you're the problem, you're a spiv, you're this, that, and the other, and it's like, yeah, I'm not. This is why I shouldn't be allowed out, realistically. Try and provide reasoned analysis on such an emotional topic, But
so that's why you've got 4 Guardians with you on a Sunday morning now. What's happened here?
That would be ideal. But if anybody else has got anything to add to that, I'd love to hear it, because it's a bit of a roundabout answer, I know.
I mean, my view is
we're just about to get to the end of this, because we finished 5 minutes earlier for the Remembrance Day. So I think it would be good.
A cliffhanger for next week.
Yeah.
Hold that thought, Jay Howard.
Yes, and it seems like we kind of run out of time to talk about the blockchain stuff and the innovations that happen with that, and how this all comes first.
That gives us a week to research, so we can actually add something to this conversation.
Yeah, I did it all on purpose, because I know nothing about that space at all. So we need some time to research.
I typed it into my
one more week for homework.
I typed it blockchain into my computer and it came up Blockstein. I don't know if that's a thing.
Probably best not to share your Google search history live, mate. I'm just saying.
Okay.
Well, looking forward to your contributions next week with us.
I'll try.
Let's stay in more chain if we could.
Yes, and Jay, you'll have some more airtime as well. So, well, thanks everyone for listening in to this chat. If you enjoyed it and you think other people will enjoy this, you can share this and get more people to join us at 10 a.m. on Sundays.
And keep your questions coming in, folks, as well, because we love to try and answer anything. Make them as difficult as you like.
Yes.
For Adam.
Nice one. Okay, guys. Thank you so much. Speak soon.
Bye.
Bye.
And